In today's episode, we will be going over the basics of charting and candlesticks. Welcome back to the Zero to Hero series, where we teach you how to go from absolute zero to becoming a hero in these markets. So, just a quick recap of what this series really is. We will be going through 4 different lectures going over the basics of charting, reading price action, finally building a trading model, and then we will conclude with an execution of a trade example. So, without further ado, candlestick basics. Price is organized through intervals of time, through from minutes all the way up to weeks. Since markets are ran on the basis of time, we focus on time-based candlesticks to determine significant structure. We will also consider time plays an important factor in terms of economic releases. These scheduled events bring volatility into the market and they can create context for us to work from. We will also consider the importance of the 3 sessions that create a daily formation from Asia to London to New York. Every candlestick has an open, high, low, and close. And remember, the colors signify whether we close above or below the open. That's what creates a bullish or bearish candlestick. The arrangement of these candlesticks is what creates market structure. So if we look to the left, we can see a couple swing points. A swing low is created when there is a candle higher on the left side and the right side of that low, and the opposite goes for a swing high. Think of a V formation. Low, low, and low. When we look at swing highs and swing lows, we look at swing highs and swing lows when evaluating where the market may be headed next, because traders will place their stop losses around swing points in the market. We will also compare the size of candlestick bodies versus the size of the wicks. Both measurements are important and they will have different uses, as you'll see. Everything you need to know can be found in how price reacts to swing highs and swing lows. So in our analysis, we will look at multiple time frames to get an idea on structure on multiple perspectives. Candlesticks are just an organized way of keeping track of a large amount of data. This is all we will be using to analyze price. No indicators, just comparing candlesticks over time. So when there is a series of swing highs or swing lows at the same level, that creates a pool of liquidity. In markets, they will often try and stop out traders before making the real move. We wait for this manipulation to occur before we engage in price. Now, what does this mean? If we can see very visibly that there would be a reason for a lot of traders to put a stop loss order in a specific area, we can almost always expect that the market is going to stop at those traders before continuing higher. Why does it do this? Well, because the market runs on liquidity. It needs losers in order for the big fish to win. We know that a majority of retail traders lose. So when we use that logic, we have to figure out how do we go against what the majority do. So the process of generating liquidity through the use of stop orders is necessary for the market to create larger moves after it purges that liquidity. And again, there are swing points. They can be relative equal highs or lows. These can be considered targets or an indication of a potential reversal. Then we have the bodies versus wicks. The wicks do the damage. They tag the levels. They reach for price. But the bodies carry the significance. Whether they close above or below a level often determines if a reversal is coming. And lastly, markets run on liquidity. So we know that traders are often stopped out of their trade before the real move begins, and we use this information to our benefit. Moving forward, when considering price, there is a few different stages that price can be in. A trending phase in price is when the market is making lower highs and lower lows. That would create a downtrend. Just think of like a stair step lower. Or vice versa, an uptrend would be higher highs and higher lows. The market can also range, consolidation phases or equal highs and lows. That usually comes after a period of trending. And lastly, reversals or retracement. A reversal occurs after a higher time frame level of liquidity has been hit. Retracements, however, are normal within a trend. Think of them as a smaller time frame reversal. So markets can have a lot of retracements when they're making higher highs and higher lows or lower highs and lower lows. When discussing the formation of a daily range, there's three main sessions that we're considering. We have Asia, which is generally speaking a consolidation from around 7 to 12. London, which can often create a reversal for the day, where markets, if they want to close in one direction, London will normally form the higher low. That can be found anywhere from 2 to 5 a.m. Eastern. And lastly, New York session, there's a number of potential tendencies, and this is the session that we will be trading personally. That can be from 8:30 to 11 a.m. Eastern, and then there's also a PM session from 1:30 to 3 Eastern. Continuing on, let's discuss some relevant areas in price. Areas of inefficiency are often where price will want to return. This offers a trade opportunity in some cases. So as you can see here, there's three specific price areas that we are referring to. This top section, we have an area called gaps. That is basically where there is no wicks that overlap in that shaded area. So when we are in a trending model, I will look for price to pull back into one of those gaps where I will enter a position. Now wicks, these can be measured and use as swing points. It's another form of market analysis. You can sometimes expect half of a wick to fill if it's a very large wick, and so on. And lastly, we have order blocks. So these are areas in price. They are specific candles that signify a change in the direction. So we see that price, it swept liquidity on that second swing low, and it also tagged an important level. Now, when price breaks above that series of down candles, it is signifying to us that there has been a change in the state of price delivery. Continuing on with more relevant areas in price, we have single point liquidity, which would just be a single swing low. And this is relevant. You'll see this sometimes in trending markets where this level gets taken out. We have relative equal highs and equal lows, where in a consolidation, you'll often see these areas. And then lastly, you also have liquidity voids, where there is no trading that is occurring, and price shows gaps between two candles. This often happens when there is a new day that starts, a new week that starts, and so on. So in this lecture, we went over significant areas in price. We talked about the basics of candlesticks and charting. In the next series, we will continue our expansion on these topics. So thank you for watching. Enjoy. I hope you got something out of this. Like, share, comment, and we'll see you next time.